Welcome back to the ACCA Academy. In today's video, we'll be diving into lifecycle costing as part 2 of our Specialist Cost and Management Accounting Techniques series. If you missed part 2, where we covered target costing, you'll find the link in the description below. Make sure to check it out for a complete understanding. Let's get started. First topic is what is lifecycle costing. Lifecycle costing is a comprehensive approach to cost management that evaluates the total costs associated with a product, project, or system over its entire lifespan. It encompasses all expenses incurred during various stages, including research, development, production, operation, maintenance, and disposal or decommissioning. Unlike traditional cost accounting methods, which often focus only on initial or operational expenses, lifecycle costing considers both direct and indirect costs over time. This method enables decision-makers to assess the long-term financial implications of their choices, compare alternatives effectively, and optimize resource allocation. By identifying potential future costs, such as maintenance, upgrades, or end-of-life disposal, lifecycle costing promotes more sustainable and economically efficient practices in areas like project management, procurement, and product development. Next topic is key concepts in lifecycle costing. Total cost of ownership. Lifecycle costing assesses all costs incurred throughout an asset's life, including acquisition, operation, maintenance, and disposal, providing a holistic understanding of financial implications beyond initial expenditures. Cost phases. Costs are categorized into stages: initial costs, design and development; operational costs, energy and maintenance; and end-of-life costs, disposal and recycling, ensuring a structured evaluation of long-term cost impacts. Time value of money. Lifecycle costing incorporates the time value of money by discounting future costs to their present value, ensuring accurate long-term cost comparison and financial planning. Decision-making tool. Lifecycle costing aids in evaluating alternatives by comparing long-term costs and benefits, guiding organizations to choose the most economically viable and sustainable options. Sustainability and efficiency. By identifying hidden costs, such as energy consumption and disposal, lifecycle costing promotes sustainable practices and resource optimization throughout the asset's lifespan. Cost transparency. It provides a detailed breakdown of all direct and indirect costs, enabling better cost control and understanding of cost drivers for informed decision-making. 7. Applications. Lifecycle costing is widely applied in construction, IT, manufacturing, and public procurement to ensure investments deliver maximum value over their full lifespan. Next topic is benefits of lifecycle costing. Comprehensive cost analysis. Lifecycle costing provides a detailed evaluation of all costs incurred across a product's lifecycle, ensuring a holistic understanding of total costs, including acquisition, operation, maintenance, and disposal, for better financial planning and control. Improved decision-making. By considering long-term costs, lifecycle costing enables managers to make informed decisions, choose cost-effective options, and optimize investments that align with the organization's financial and operational goals. Identification of hidden costs. Lifecycle costing uncovers hidden future costs, such as maintenance, energy consumption, or end-of-life expenses, helping organizations proactively manage resources and avoid unexpected financial burdens. Enhanced cost efficiency. It promotes resource optimization by identifying cost-saving opportunities throughout the lifecycle, from initial design to disposal, leading to reduced total costs and increased profitability. Support for sustainability. Lifecycle costing encourages environmentally responsible practices by accounting for disposal and recycling costs, reducing environmental impact while ensuring compliance with sustainability goals. Accurate cost comparisons. It enables a fair comparison between alternatives by evaluating the full cost implications of different options over their entire lifecycle, ensuring the most cost-effective choice is selected. 7. Long-term value maximization. By focusing on total lifecycle costs, organizations can achieve greater value from investments, ensuring products and projects deliver sustainable financial and operational benefits over time. Next topic is steps in lifecycle costing analysis. Identify costs. Identify costs. Determine all costs associated with the asset, including initial acquisition, operation, maintenance, and disposal costs. Estimate time frame. Define the period over which the costs will be incurred. This time frame usually corresponds to the expected useful life of the asset or project. Accurate estimation of the life cycle is critical for effective analysis. A longer time frame might involve uncertainties, so assumptions should be realistic. Discount future costs. Future costs must be adjusted for the time value of money using discounting methods like net present value, NPV, or internal rate of return, IRR. Discounting ensures that future expenses are expressed in terms of their present value, making comparisons meaningful in accounting for inflation or interest rates. Calculate total cost. After identifying and discounting all costs, calculate the total lifecycle cost by summing these values. This gives a single figure representing the TCO, which is critical for comparing alternatives or evaluating project viability. Analyze results. Once the total cost is determined, compare the lifecycle costs of different alternatives. This step helps identify the most cost-effective option, considering long-term financial implications rather than focusing solely on upfront expenses. 6. Monitor and review lifecycle costing is not a one-time activity. Periodic reviews are necessary to compare actual costs with projected estimates. This ensures that the analysis remains relevant and helps adjust for unexpected changes or deviations. Next topic is challenges and limitations of lifecycle costing. 1. Data availability and accuracy. One of the most significant challenges in lifecycle costing is the availability and reliability of data. Estimating costs such as maintenance, operational, and disposal expenses over the asset's entire lifecycle can be difficult. Inaccurate or incomplete data can lead to incorrect conclusions. 2. Uncertainty and assumptions. LCC relies on several assumptions, such as the asset's lifespan, future inflation rates, interest rates, and discount factors. These assumptions are inherently uncertain, and even small errors in forecasting can significantly affect the results, making the analysis less reliable. 3. Complexity of analysis. LCC involves a detailed evaluation of various cost components over an extended period. For complex projects, this can become highly technical and time-consuming, requiring expertise in financial modeling and forecasting. 4. Subjectivity in cost allocation. Allocating costs to different stages of the lifecycle can be subjective, especially for shared resources or indirect costs. This subjectivity can introduce bias, making the results less objective and transparent. 5. Difficulty in capturing intangible costs. Certain costs, such as environmental impacts, reputational risks, or employee well-being, are challenging to quantify and often excluded from LCC. Ignoring these intangible factors can lead to an incomplete analysis. 6. Limited applicability in dynamic environments. In industries with rapidly changing technologies or uncertain market conditions, the results of LCC may quickly become obsolete. This limits its applicability for assets or projects subject to frequent innovation or regulatory changes. 7. High initial effort and cost. Conducting an LCC analysis requires significant upfront effort, resources, and expertise. Organizations with limited budgets or technical capacity may find it difficult to implement, reducing its feasibility for smaller projects. 8. Overemphasis on cost. LCC focuses heavily on financial considerations, potentially overlooking non-monetary factors such as quality, flexibility, or strategic alignment. This narrow focus can lead to suboptimal decision-making in broader organizational contexts. Thank you for watching part 3 of our lifecycle costing. In this video, we discussed the lifecycle costing and key concepts in lifecycle costing and benefits of lifecycle costing and steps in lifecycle costing analysis and challenges and limitations. Want to continue learning? Check out part 4 where we discuss throughput accounting. The link to part 2 is in the description below. Don't forget to subscribe to First Step Study for more educational videos.